Hi everyone, I'm Doug Alsdorf. In this short video, let's talk about how a $50,000 investment in the S&P 500 could grow to $2 million. That sounds fantastic. Well, what's the catch? After watching this short video, please watch the videos and read the PDFs for Chapter 13 and have a look at those S&P 500 spreadsheets that come in Chapter 13. Chapter 13 is my favorite in the book, and this plot is the crescendo of Chapter 13, so it's one of my favorite figures, and I'm glad to share it with you. So, as always, when given a plot, please have a look at the axes first. So, along the y-axis, we have an amount of money, and along the x-axis, we have the number of years that the person has been invested in the S&P 500. And please note, reinvesting their dividends while doing that. Over here, we're going to kind of go off the chart and start with a $50,000 investment. How much money would the person have after 10 years, after 20 years, after 30 years? How about after 35 years? Well, from 1935 to present, there's a 35-year window. From 1935 to 1970, that's a 35-year window. From 1936 to 1971, that's another 35-year window. Actually, if we increment that monthly, then we'll have over 600 windows that fit in there, ending, I should say, at 1970, all the way to ending at 2025. So there's over 600 windows that fit in there. We take all the data in there, starting and stopping, and get the average of all the gains made on a $50,000 investment. We see that on average, we would have made $2 million. Our $50,000 over 35 years would have grown to nearly $2 million when invested in the S&P 500 and reinvesting our dividends. This means that we're investing in a mutual fund or an ETF that is an index fund, buying and holding that index fund. In fact, what started me on my whole investing journey is I wanted to know, okay, I like the idea of buying and holding, and I like the idea of index funds. They have a lower risk to them than individual stocks, but how long do I have to hold? So this chart that I created from working on Chapter 13 helps us to understand that how long. So of those 600 values, 600 more, there's more than 600 values, of those, there's also not only an average, but a standard deviation. We can subtract one standard deviation from the average or add one standard deviation to the average and then get 68% of the values fit within the gray box. And that might be our actual expectation. Those are measurements that fit within our expectation. There's also a model fit to the data, and I talk about that in Chapter 13. If we fit a line to the S&P 500 while reinvesting dividends, we come up with a 10.5% annual gain. That's this black line right through there, and we see that it's usually in the lower half of the gray box, suggesting that it's actually underfitting the data. And then on the measurements suggest we should expect more than the 10.5% value as you see there. So that's over 35 years. We might say we're expecting almost $2 million, maybe as high as looks like about $2.3, $2.4 million, or as low as say about $1.6 million to fit within the overall 68% of the data. We can do the same thing here with 30 years, or even how about down here at 20 years? If we're in the S&P 500 for just 20 years, we might be hoping for nearly a $500,000 gain on average, but we could be as low as about 200,000 or as high as about, looks like about 800,000. But keep in mind, this past has also seen some really bad times, which was the lost decade. Had we started in the year 2000 and ended in 2020, we'd be at 168,000, which is actually outside of the gray box. So let's wrap this all up and say that in the past, a one-time $50,000 investment while reinvesting dividends in the S&P 500 made $2 million, give or take, say, $500,000. So what's the catch? Well, first off, you got to come up with $50,000 in the first place. In the book, I explain how I think you can do that. Let's say throughout your 20s, each year you can find $7,000 from your income to invest in a tax-deferred account. So $7,000, say, times 7 years, that's $49,000, call it $50,000. Or maybe you can come up with $5,000 and your company will come up with $2,000 and you'll invest it in your 401k. The important point of those is those are tax deferred accounts, meaning the dividends are not being taxed while you're doing the investment. So the real catch then becomes you got to wait 35 years. So let's say you're 23 years old, 7 years later, you're 30 years old, and now you got $50,000. Now you just got to wait 35 years until you're 65 years old, so to speak, when you might retire at that age. So that's a long time to wait. You also have to use a tax deferred account, an IRA or 401k. And as always, the past is absolutely no promise of what will happen in the future.